Well, thank you very much, and thank you very much for inviting me. It's a real pleasure to be here. It's a pleasure to be in this room again. I think the last time I was in this room was the BIS Annual General Meeting 2013. The UK sat over there, and Mervyn King and I would sit next to each other, and for years we would have this debate about, shall we vote against one of the motions? And we would egg each other on, go on, you be the one, or should we vote different ways and confuse the, and this is how we managed to get through that morning. Anyone who either knows, who has been at the AGM will know that one of the imperatives of life is to survive that morning here. Yesterday was great fun and actually rather uplifting for me. The truth is that although I think that good laws have been passed around the world and a lot of progress has been made in pursuing resolution strategies and resolution regimes, big picture, I think that the top people talk about it too little. I'm surprised how little they talk about it, given how important it is. And to underline that, I think last time I was here, about 3 years ago, in my new private capacity, I said that I thought that if there was another financial crisis and you couldn't cope, that this would be the greatest threat to liberal democracy in about 80 years. And I had a drink with someone a couple of nights ago, and they reminded me of this, and they said, this person said to me, this person is German, by the way, and they said to me, I thought, that sounds good, but, and they said, but you were right, weren't you? And I said, well, you know, we haven't yet seen the end of the financial crisis that we had in 08, 09. It is still playing out. And in my view, it will still be playing out for another decade or so through politics, through culture. There are lots of twists and turns remaining. So I have been a little bit disappointed that the top people don't talk more about resolution and too big to fail. But yesterday I realized that perhaps the reason they don't is that they know that the extent to which it's been socialized in your community, the extent to which resolvability, resolution has become deeply embedded in deposit insurance agencies is magnificent, frankly, and completely different from anything that I was aware of. So yesterday was a good day for me. Mark opened yesterday morning with some ridiculously flattering words about me, which I mention only because it's embarrassing to mention them, but I mention them only because I hope everyone in the room knows that the bail-in idea is just as much, and in fact the bail-in label comes from Wilson Irvin at the back of 2009. The first time I talked about it publicly was in the spring of 2010. The thought occurred to me during the winter, in fact long Christmas walks in 2009, thinking about, well, I've got the chair of this committee, what the hell are we to do? And you kind of, it's a great privilege to be given the opportunity to chair things that really, really matter. And then you have this moment of alarm when you think, well, what is there an answer? And the answer, of course, is the losses have to go somewhere once the equity is exhausted. And that's the only thought, actually. The losses have to go somewhere, and where do you want them to go? And if they don't go to creditors, then they are going to go to taxpayers. So if you don't want them to go to taxpayers, they're going to have to go to creditors. And then you think, well, which creditors would you like them to go to? And then you think, well, actually, you don't want them to go to certainly not insured depositors, obviously, or even uninsured depositors or trade creditors. So you get driven to thinking about the creditor stack and about the structure of banking groups. And that is really all there is to it. And so it's remarkable, absolutely remarkable, and in truth I feel shameful, including in my own country, the UK, that none of this had been weighed enough before the 2008-2009 crisis. As many of you know, when Northern Rock failed, we had no resolution regime whatsoever in the UK. If only in the previous 30 years we had noticed what the FDIC were doing in the United States, Northern Rock would have been a relatively straightforward bank to resolve. And I mention that actually because I think there is a lesson for this tower. I mean, how is it that the cooperation and exchange of views starting after the Hallstatt failure in the middle of the 1970s, initially under one of my former bosses and mentors, George Blunden, who was the first chairman of the Basel Committee, how is it that in all of those years it wasn't recognized that resolution mattered just as much as supervision? Why didn't any of the governors push that through? Why didn't actually, although I think the FDIC is the least to blame for this, why didn't the FDIC bash on the door and say to other countries, you're getting something wrong? And it makes me think, what else is there now where some countries are completely ill-equipped to deal with the challenges that they might plausibly face, even when some of their peers in the world have all the powers and technology that they need? And so something else I wanted to say is I think it's terrific that the FSI is now interested in resolution and not just in supervision. When I was a member of the board of the BIS, which was a wonderful privilege to have, although it came about in tragic circumstances after Eddie George passed away, I did feel that the scope of the FSI was too narrow in the past, and I think it's great that it's broadening. So, if the countries of the world hadn't learned enough from the United States and the FDIC about how to resolve small and medium-sized banks, no one had the answer for how to resolve really large and complex financial institutions. And as I said, the answer which Wilson advocated and later I advocated was, well, you have to put the losses on bondholders, and you have to structure banks so that this is possible. And as I think Marshall Wilson said yesterday, in 2013, and I think my last speech while I was in office in Washington, I said that I thought the United States had the wherewithal to do that then, but it wouldn't be comfortable. And here is the first substantive point that I want to make. I am concerned that your community has slipped into the shorthand of saying, we have solved too big to fail, or accepting that as a question. Have you solved too big to fail? And people sit at tables like this, and they don't want to say no, because they don't think the answer's no. They think they have made real progress, and so they say yes. And I don't think that is a very sensible thing to do, because it invites the question, well, God, if they've solved too big to fail, next time that a really big firm fails, it will hardly notice. It will be fine. Whereas even on the Tucker view, even if everything I've ever said about resolution is true, which can't possibly be the case, of course, but even if it were, it won't be. It won't be absolutely fine. It'll be pretty bad. And I regret, looking back, that I didn't make the following point clearer. Crisis versus non-crisis isn't binary. It's a spectrum. I really do think it is circles of hell. My generation of central bankers, our generation of central bankers, I do think that we did better than our predecessors in the 1930s. We did not have the Great Depression. They were in a much worse circle of hell than we found ourselves in 2009, 2010. The next generation, your generation, can do better still. But if Goldman or JP Morgan or Barclays or someone fails, it will be bad. The question is, will it be so bad that the only sane thing for elected members, politicians to do is to bring fiscal might to the situation and bail out equity holders and bondholders? And I don't believe that's the case. I believe the social costs will be serious, but not so great that that is the only option they have. And I think that officials ought to get across that it's going to be messy, but it's going to be a lot less messy than the back end of 2008 and 2009, and that will be a hell of an achievement. But And in that sense, too big to fail is solve, but I don't think that's the right slogan to use. The second thing I want to say is about the implications of resolution policy for the lender of last resort and for supervision. So I'm not completely confident about this after yesterday, but my hope had been that good, robust, credible resolution regimes would bring about some kind of transformation in the way that the lenders of last resort thought about themselves and in the way that supervisors think about themselves. And I see scant, not zero, but scant evidence of this. Let me start with the lender of last resort. So the key thing about credible resolvability for the lender of last resort is this, that if you as the lender of last resort are faced with an institution that is fundamentally insolvent, and so that it isn't just a liquidity panic, then you should not lend to them. Then you should put them into resolution. And if you have an institution that is fundamentally, it's in a bad way, it's suffering a liquidity crisis, but it's fundamentally solvent, it's fundamentally viable still, and you do lend to them so as to avoid the unnecessary social costs of liquidity crisis, but that while your central bank loan to them is outstanding, the firm deteriorates further for whatever reason, and it becomes insolvent, you should pull the liquidity assistance and push them into resolution. Now, why does this? Actually, I think that's not only good economics, I think that's actually good political economy, and actually I think it's almost a moral truth. I don't think unelected officials have the right to go around providing fiscal assistance to fundamentally insolvent firms. Why does it matter? Any of you that have followed the debate about the Federal Reserve in the United States will know that the Federal Reserve is perceived, fairly or unfairly, by members of Congress on both sides of the aisle as having overstepped a limit and provided assistance to fundamentally bust firms. I am not saying that they did so. I'm in no position to know, and they are good people. But that perception definitely exists on both the Republican side and the Democrat side, and it has caused the Federal Reserve no end of trouble in Congress, and it will continue to cause them no end of trouble. And what resolution does, in my view, is it relieves the central bank of the great dilemma of, in order to save the nation, in order to protect the people, should they step over some blurry line? Should they shade their assessment of fundamental solvency or insolvency? And with a credible resolution regime, the answer to that is no, absolutely. If anything, you'd shade it the other way. We think this is fundamentally bust. Hand it to the resolution people. And that, of course, is incentive compatible for those concerned. Now, were that truth, as I see it, in the oxygen, in this tower, and the tower of the great men and women who sit at the top table here, I think one would hear them shout about it a lot in speeches about lender of last resort. In fact, I think that every speech about lender of last resort should start off being about resolution policy. And I don't detect that at all. And I certainly don't claim to have read every speech by central bankers on lender of last resort over the past 4 years. For someone who's retired from central banking, that would be rather eccentric. But I've read quite a few of them, and they don't do that, and therefore I think they are missing a point, and a really kind of existential point almost. So that's what I have to say about the lender of last resort and resolution. What about supervisors and resolution? So part of this is cultural. So whereas securities regulators and central bankers seem to truly hate each other for reasons that I have absolutely no idea what the deep causes are, and I should put my hand up and say I designed the securities regulatory system in Hong Kong, or at least I helped do so, so I have some tribal affinity with securities regulators. The relationship isn't hugely better between supervisors and resolution staff. And that is as true today, given the anecdote and gossip I pick up, as it was 10 years ago. And this is a bad thing. This is a bad thing. The reason resolution matters is that supervision will sometimes fail. And it will sometimes fail not because people are bad or incompetent, but because no one has ever tried to design a supervisory system that can guarantee against failure. And the best protection of the integrity of prudential supervisors is that there is a credible resolution regime into which they can put their firms. And this would mean greater respect between resolution authorities and supervisors in all of the major jurisdictions than I think probably exists today. And I think the top people in this building should wake up to this cultural truth, which they know in their heart of hearts because some of them served as junior officials in the way that I did a long time ago. Now, the more kind of constructive thing to say is that substantively the big effect of resolution and the big insight really that followed the crisis, not a technical insight, is, my God, supervision doesn't always work. And therefore we can't put all of our eggs in the basket of we will rely on supervision, and then when it fails, we'll go to the finance minister and ask for a bailout. Instead, we need to work back from, there will sometimes be failure. How should banking groups be structured and organized so that we can cope with failure in a reasonably tolerable way? And if you think about it like that, so-called SPE and MPE, which were slogans, single point of entry and multiple point of entry, resolution, which came up a number of times yesterday. These aren't techie things that are of interest only to your community. These are the most important moments in the structure of banking probably since the 1930s and 40s. The most important thing to know about any of the big banks and dealers in the world is, are they single point of entry or are they multiple point of entry? And if they're multiple point of entry, how many resolution subgroups are there? And this to me matters hugely more than Volcker or Vickers or Liikanen, and yet it gets so much less attention in the media and amongst the brokers and analysts that look at banking. And the internal TLAC was talked about yesterday, which is integral to making either SPE or MPE work. And when we were first thinking about what became called internal TLAC, which is just a contract between the subsidiary and some intermediate or ultimate holding company, I thought about it in terms of trying to give reality to the relationship between host supervisors and home supervisors. So a harsh truth is, and I'm going to exaggerate this, is that a lot of bullshit is talked about the cooperation that goes on in colleges. And that's because everybody that sits around a college has incentives to say it is working really well. And if you think about every college always says it's working really well, about every bank across the whole of the world, and then ask yourself the question, do I think it is plausible that 100% of them would be working really well? You've got a hint that actually maybe it's rather crude to call it bullshit, but it's maybe a degree of exaggeration, even self-deception is going on. And the reason, of course, is that no one has got incentives to say, well, we try to cooperate, but we're not really. It's hard to cooperate in failure. I was lucky enough to be private secretary to the governor of the Bank of England in the late 80s, early 90s, when Eddie George, a truly great central banker, was deputy governor, and when Jerry Corrigan, a truly great central banker, was president of the New York Fed. And BCCI failed in that period, and no two people could have been closer professionally than Jerry and Eddie. And Jerry phoned up, and I was listening in on the phone from the governor's office, and Jerry said, we're not going to play ball. We're going to do our own thing. And actually the degree of cooperation between them as men was that Jerry told him in advance. And that was the limit of it. And Hong Kong did the same. And Hong Kong was still under British control at the time. So, it is hard to cooperate ex post, but ex ante you can do it. The point about the internal TLAC, which is essentially a contract where the losses of the subsidiary get pushed up to the holding company, is as follows. 4 parties have to agree to that. The board of the subsidiary, the board of the holding company, the supervisors of the subsidiary, the host supervisors, and the supervisors of the holding company, the home supervisors, and any of them could say no. And the important thing is once they've said yes, it's too late. So they have incentives to think about whether they really mean yes or no. And if they say no, they are revealing to each other that they will not cooperate. And part of the motive, therefore, it's not just technical, of what's going on in this area, is to make a reality of supervisory cooperation, where it counts as cooperating to say that you're not going to cooperate, but before the failure, rather than during the failure, as Eddie and Jerry did that day. The other thing it does, by the way, I'll just say this in passing, it makes a reality of the idea that consolidated supervision is meaningful, which I think it probably hasn't been. I think that the revisions to the Accord in the early 1980s, after Banco Ambrosiano failed, were lacked substance in terms of what went on in the real world, and it makes a reality of the idea that the parent is a source of strength. The parent is a source of strength only if the parent is absolutely committed and has the wherewithal to provide resources. Let me say one other thing, and then I will stop. There is one, I'm not sure you and I have ever talked about this, Wilson. There is one major criticism offered of the kind of bail-in, SPE, MPE approach. It's been advanced by people like Charles Goodhart and others. And it goes along the lines of, well, this might work if a large and complex financial institution fails in isolation, that they have idiosyncratic problems, say because of fraud, but it will never work when lots of SIFIs fail together, and of course, lots of SIFIs do always fall together because they're SIFIs. And therefore, the only solution will be bailout, and we ought to face up to that. And it's all a load of puff, and in fact, the Tucker thing is as full of bullshit as he says other things are. That's although Charles never quite brings himself to say, put it quite like that. And there is a germ of a thought in there, but it is only the germ of a thought. First of all, it is not true that SIFIs always fall simultaneously or together. If Bear Stearns, when it failed in the spring of 2008, had gone through a resolution process, I would suggest to you that the incentives of the people at the top of Lehman to reach a deal with whoever it was, I think it was in Korea, would have been far greater than actually played out in reality. And on a smaller scale, remember that resolution works as a shadow as well as an act. Later on today, we're going to hear about the Italian mess and the Spanish successes. What we're not going to hear about is the case in the UK, which I personally wasn't involved with, where a private sector solution was found for an ailing bank in the shadow of resolution. And whether the officials, of course, would say that, particularly the officials that used to work for me. But actually, what's interesting to me is that the lawyers and bankers involved with that deal said, oh, yes, yes. Everyone had strong incentives to find a private sector solution because we knew that the UK Resolution Authority was ready to exercise their powers. Part of the way that government works is to create incentives for people in private markets. And I think that the fact that resolution can work idiosyncratically for SIFIs is not negligible. The germ of the thought is, well, what if the authorities are hit with 5 SIFIs falling on the same day, day or seeming to be ailing on the same day. It would be quite something for all of them to be put into bail-in by the resolution authority, by unelected officials. But I think there is a solution to this. And I'm going to both give you what I think the shape of the solution is and what I mean by solution. I think the solution is that the elected executive branch should be given powers by the legislature to simultaneously resolve/bail-in a series of banks, dealers, whatever, at the same time. They would effectively declare a state of emergency. Therefore, the criteria for doing it will be subtly different from the case-by-case evaluation that goes on for single firms going into resolution one at a time. And because the criteria and the threshold would be different, I personally don't believe that power belongs with unelected officials. I think it belongs with elected officials. The critique could then be, well, they'd never do it. And that, I think, actually fundamentally fails to understand what a democracy, or even any government, non-democratic government, is. It's about the people that we elect choosing. So to have the Prime Minister of Britain or the President and the Congress of the United States or the Chancellor of Germany only having one choice, which is, I now need to bail them out, is a terrible place to leave them. And it isn't their job to think of other options that they should have. It's your job. And it's their job, and it's your job to take other possible options to legislatures and try and get them on the statute book, and then it's their job to decide which of their powers to exercise. And it may be right that in some circumstances that they would fall back on bailout. That's certainly Tim Geithner's view. But I don't think it is at all wise to leave them with that choice and only that choice. I will close there. The moral of the story, and this is why I teased Ava yesterday, is everything goes wrong. Absolutely everything will go wrong. And you don't know when. And the job of the people in this tower is to think of, and what can we do then? What can we do then that might make it slightly better, might make the pain and distress felt by the public slightly less than otherwise? What might make the political fallout slightly milder than otherwise? Because everything will fail. Everything that's being discussed in this conference will fail. But you will still be a lot better off than my generation was 10 years ago. Thank you.